Today's lesson is about the good news and the bad news. Like Rosanna Dana says, it goes to show you it's always something. So, what's the bad news? Well, the banks are broke. They got no money to lend you. The good news is, in the grand scheme of things, you've still got some great opportunities. Now, here with some comforting thoughts on how to take advantage of these opportunities is your man, the Money Man. Here's Dan Frischberg.
Thanks very much for joining me. There is tremendous opportunity right now, and I can't wait to get to some of this stuff. So what you're looking at now, this is just the banking industry's notes to themselves. And essentially what it's showing is tighter standards and weaker demand for commercial and industrial loans, tighter standards and weaker demand for all commercial real estate loan categories, all categories of residential real estate loans other than government, and demand weakened on all real estate loan categories. In addition, banks are reducing lines of credit, and moreover for credit cards. Anyway, bottom line is banks don't have as much money and they're raising standards. They don't have confidence in the future and they don't have money. Now, what I want you to see is this is the history of domestic banks when they tighten their lending standards. And you can see that we're at about the tightest that we get. And the dotted line is showing what turns out to be recessionary levels of loan tightening standards. Obviously, they didn't want to do a lot of loans during COVID, and they didn't want to do a lot of loans as the economy was crashing in 2008, and they didn't want to do a lot of loans in what we call the tech wreck in 2000 as the economy went into recession and very little confidence in anything, and the banks don't want to lend any money. But what I want you to also notice is the years that these happened, that these levels have always ended up not only with a painful slowdown in the economy, but a new president every time. When the lending standards got high like this, it also meant that the economy, people hated the way the economy was. They didn't like the way their lives were, and they threw the incumbents out of office. And so that gives you a good example of why the present incumbents are a lot worried by the recessionary level of domestic bank tightening. And a lot of that tightening is coming because, first of all, they bought a bunch of bonds to help finance all the deficit spending by the government. And then the Fed went in without thinking about the consequences and jacked up the interest rates. And when the interest rates went up, the bonds that the banks bought were worth about half the money that they used to be worth. They bought a bond with a 1 or 2% interest rate, and now the government is issuing bonds with 5% interest rates. So what is the bond that the bank owns worth? Not much. Now, the Fed has gone in and bailed them out a little bit by lending them $1,000 on every $500 bond. But those loans are coming due over the next few months, and the bank doesn't really know what they're going to do about it. They're hoping that the Fed will extend the loans. I ask you, what are the chances of the Fed allowing those banks to go to fail while they can't really, remember, they would have to repay the $1,000 that they borrowed on each $500 bond, and they really probably don't have the money to do that. The Fed is not printing a lot of money and buying their bonds from them right now. Also, the businesses that have been borrowing money from those banks were borrowing the money earlier at a much lower interest rate. Now, if they come back to renew their loan, a store that's borrowing money to support its inventory, et cetera, they come back to renew the loan, the bank says, well, you're at the bottom of my list and I can't really lend you any money. That guy doesn't have the money to repay the loan and can't continue it. So he's going to fail and the bank's not going to get paid. If it is somebody that the bank wants to lend money to, a small business in better shape, then the bank says your credit line's not going to be 6% anymore. It's going to be 14%. And that guy has to say, well, I don't have the money to pay you back, and I can't support my business at 14%. So I'm going to fail, I guess. So this is all the things that everything that the bank does is on the verge of failure. And so I can't promise you what's going to happen. I ask you, what are the chances that the government who wants to be reelected and the central bank whose job it is to keep the economy going, what are the chances they're going to let all that happen? I think pretty slim. This is personal interest payments by human beings, by people. And you notice that the personal interest payments are way, way up compared to what they've ever been before, because we used to have low interest rates, but people borrowed a lot of money. And then we had people borrow money, but they didn't borrow that much money compared to the inflation that we have now. Now they are borrowing huge amounts of money and the interest rates are very high. And so the personal debt service is astronomical compared to anything we've had before. People are also in trouble. Here's the United States government debt as a percentage of our GDP. And you can see that the federal government's debt in blue is the highest it's been since World War II. Of course, we know why they borrowed a lot of money in World War II, and we know why they borrow money sometimes now. But basically, federal debt is as high as it got compared to the GDP. Remember, our GDP, our production of our economy was much, much, much lower in 1945 and 1940 than it is now. Now, the non-federal debt means states and local governments and everybody and supporting the police department and the fire department and everything. And they have a lot of debt too, which they're having to renew at very high interest rates. They don't really have the money to do that. Neither does the federal government. So as the Fed raises interest rates, they're putting the government who they work for into a huge dilemma because the government can't afford to renew. Think about the loans that they have that are coming due: 1 year notes, 2 year notes, 5 year notes, 10-year notes, 20-year. Think about the loans that the government has, bonds that are coming due that are going to have to be renewed at interest rates 3 or 4 times what they used to be. How is the government going to do that? Well, I guess they could print some more money, but that's why nobody in the world wants to lend our government money. That's why the interest rate is so high. People around the world used to want to hide their money in U.S. treasuries because that was the safest place to keep money. Now we've shown them, first of all, if you do what we don't like, we may put you into sanctions and take your bonds. And number two, we make stupid decisions. We don't run our economy well. We're having runaway inflation, and we want to borrow more money from you. So when you go to the bank with a story like that, I mismanaged my company, I'm running out of money, I can't pay my debts. Does the bank want to lend you money? And do they want to give you a good interest rate? And so, of course, the world is reluctant to lend us money at any price, and certainly not at the kind of cheap prices we're used to. So that puts the government in trouble because they still want to spend lots and lots of money, and they want to spend even more to get themselves elected. This is the federal debt costs, which are about to get higher and higher. You're looking at a slide showing you how they're going to escalate. And is the Fed going to let this happen, or is the Fed going to lower the interest rate and let them roll it over at a lower rate? Now, I have to ask you this, thinking about who's running our Treasury, Janet Yellen. Think about this. We had interest rates at 1% and at 0%. And then the Fed said, we're going to start to raise interest rates. Why didn't Janet Yellen borrow trillions of dollars at 1% and 2% by issuing bonds when she could? Even the dumbest guy in the world has refinanced his house because he knows that the mortgage rates were very low and they were going to be higher. So he refinanced his house so that he would have that loan to last longer. Why didn't Janet Yellen do that? Could it be that she is that dumb? And could it be maybe because she's an economics teacher rather than a businessman and doesn't really have any common sense when it comes to business? Because she didn't issue trillions of dollars of new bonds at very low interest rates so that she could finance all the deficit spending by the government for the next several years. That would have been pretty smart, but she didn't do it. So, do we really need a Treasury Secretary that hasn't got a clue? Bottom line is it's all coming to a head. More checkmate for the Fed because this is the amount of U.S. debt, corporate debt, that's going to mature with the next 3 years. And if the interest rates are high because the Fed hasn't started easing and causing the interest rates to go down, how many of these corporations are going to fail over the next few years? The black line is the cumulative amount of money maturing. The bars are the amount each year. And as you can see, it's just accumulating more and more. And is the Fed going to allow all of these businesses to fail, or are they going to make money more available, stop the quantitative tightening, make sure there's money in the bank, and let the interest rates float downward? You tell me what they're going to do. Because right now, this is a combination of jobless claims in red and the manufacturing capital expenditures that the Philly Fed is counting that businesses are investing to make their businesses bigger. Now, you notice that the jobless claims number is on the right and that it's actually going down as you go up. On the left is the capital expenditure, and that amount is going up. And the way that what this thing is showing you is normally they correlate, which means jobless claims go down as businesses invest more and expand. But right now, what's happening is the businesses are not expanding. So far, the jobless claims have not gone way up yet. But as you can see, jobless claims are coming because the shrinking of the economy. It's on the way. And is the Fed going to let this happen, especially during an election year? Again, for you to see what's going on, this is the stock market. And this is the S&P 500, and it is the percentages of stocks whose price is above its 200-day moving average. And right now, what you're seeing is that we've gone below that little red line again. That means that less than 25% of stocks are in an uptrend, and 75% or more of them are in a long-term downtrend. Now, what has happened is every time, and this hasn't happened very often, but 9 out of the 9 times when this happened, when the average stock, when almost all the stocks were below their 200-day moving average, that is in a confirmed downtrend, 9 out of 9 times when that happened for the first time in a year, the stock market was higher 9 out of 9 times for an average of almost 10%. So what do you expect to be happening soon? And how did the stock market, when everything is going down, what made the stock market in the previous times go up? Why did it happen 9 out of 9 times? Obviously, the central bank and or the government, or both, the central bank, the government, or both, stimulated made more money available and allowed the economy to start to grow, made the interest rates go down to borrow at the bank, made more money available, and even sent out more money and spent more money and did construction projects and everything they could to make money available. And that's why 9 out of 9 times when we were in this confirmed long-term downtrend, the stock market got better because the Fed and the government made everything get better. But right now, what we've got is you see how our money supply, we have deficit spending, and the money supply was coordinated with the deficit spending. The red is the deficit spending, the blue is the money supply. What you're seeing is now we stopped the deficit spending, the inflation rate came down, the money supply came down, the inflation rate is really correlated with our money supply. When there's too much money chasing too few goods, the prices go up, right? So we've let the money supply go down and cure itself after the astronomical amount of money printing they did during COVID. But now here's the government starting to spend more money again. Notice the red line has turned back up for all these programs that Biden is getting through. But the Fed isn't increasing the money supply. So the Fed, the government's issuing the bonds, the bank's buying the bonds, but the Fed is not printing the money and buying the bonds from the bank. So the bank's stuck with a bunch of bonds that it doesn't really want, it doesn't have money to lend you. Is this condition going to be allowed to continue during the election? You tell me. I believe that it's clear that this blue line, the money supply, is going to come back up and meet the red line, which is the amount of money that the economy needs, as it always does. In the meantime, in the short run, this is where the S&P 500 is, and you can see that has been, I told you before that it was oversold and that we were going to have a good rally, and we have had that, and now it's getting back up to a point where it may roll over. Now, I don't know what it's going to do right now. I'm just telling you that it is no longer oversold, and that it is very likely, very possible, that at least in the short run, that the S&P 500 rolls over. Now, let's start talking about what's going on here, because I want to tell you about WeWork. WeWork, this is what's going on with companies this is the commercial real estate business. And I can tell you that I was at a mastermind meeting last year, and a lot of the guys there were doing commercial real estate deals, putting together limited partnerships and funds, building commercial real estate. And a couple of them got up and were talking about the fact that if you're worried about investing, do it in commercial real estate because it always increases in value. So I want to show you, this is WeWork. This is a venture capital darling, which was once valued at $47 billion, and it was ranked as Manhattan's largest private office tenant. Now, since the pandemic, when people stopped going to work, and a lot of them have not come back to work in the office anymore, and that's why all over the country they're building pickleball courts in what used to be office buildings and bowling alleys. So what's happened is the demand for office space has been freezing up in New York City, where WeWork is the largest tenant, but all over the place. WeWork lost an estimated $15 billion over the last few years. And by the way, WeWork is now contemplating going into bankruptcy because they have a good chance that they're not going to survive at all. This is the formerly $47 billion largest private office tenant. This is what's happening with their stock over the last couple of years. This is what's happening to commercial real estate now. And of course, commercial real estate are the biggest customers of the banks. They've been borrowing the money. But the idea is that it's not the reliable investment that always goes up. Right now, it's not working that way. I'm also going to show you Bitcoin because I know a lot of people are excited about that too. And let me show you what's happening with Bitcoin as it's valued in US dollars. So there's a lot of people that are bragging about how much money they made in Bitcoin. But as you know, we have some of the most interesting con jobs ever in the history of the United States revolving around these Bitcoin, these homemade currencies, basically made to circumvent governments and their power. And of course, they have to confront the government because the government actually has an army and wants to keep its power. It does not want to compete with Bitcoin. And that's why there's a big limit. Now, the reason people like to invest in Bitcoin is because there's nothing to know. It's just like a baseball card. If people are buying it, it goes up. If people are not buying it, it goes down. But there's no underlying value to it that produces revenue, which is why if you do a little bit of work and you know what you're investing in, you can have a much, much higher degree of safety because we know that companies that are making a lot of money sooner or later are always valued at the amount of money they make for their owners. Now, our opportunity is building right now. Let me tell you what's going on because I just had the question, and the question was, what about all the 90-something% of people now in India that have access to electricity when 1.5 billion of them, most of them didn't have it just a couple of years ago. Their GDP is growing at 7% a year. They're moving into villages, getting jobs, and they need the power, the energy. That's what made us, that's what catapulted us into the 20th century and then into the 21st century. We learned how to make motors. We learned how to burn fuel to run those motors. It started out with just burning any old plants that were laying around. And then we learned how to do coal. And then we learned how to burn petroleum. And as we did these things, we just became more and more powerful and more able to do everything in the world that we wanted to do. That is the history of how we learned to use energy and to create energy. Now, I want to tell you about ESG, which is the process of the well-meaning people who want to convert, who believe, and some people believe it and some people don't, that the generating of energy with fossil fuels is creating global warming, which is happening at something like 1% every 50 years or something, 1 degree every 50 years. Whether you think that's for real or not is irrelevant. The bottom line is, this is the global energy supply right now, and it is being produced 85% with fossil fuels, less and less coal, which burns dirtier, more and more oil and natural gas, which burns very clean and doesn't really do any of that stuff. But the world is moving toward what they call an energy transition because they believe in this global warming. And they are also anti-capitalism, anti-development. They hate their society. And it's especially happening here in the United States, but also in Europe, also around the world. But after spending billions on this energy transition, as you can see, there's very little transition going on, 85% of all the energy in the world. And we have enormously growing need for energy as billions of new people join the 21st century over the next few years. So this is what's happening. Biofuels is almost 8%. That's the blue. Nuclear is only less than 2%. Wind and solar are less than 2%. Hydropower, which is very cumbersome and difficult to do, it involves drilling down and getting the heat from the earth and using it to turn turbines and generate electricity. It's very cumbersome to do and difficult. But nuclear works really well. Wind and solar, they're doing as much of it as they can. The problem is that wind doesn't always blow, the sun doesn't always shine, and these are very, very not dense ways of producing electricity and producing power. Whereas gasoline and petroleum and natural gas are very energy dense. They're very efficient ways of producing energy and turning the turbine and generating enough electricity for this billion new people who want to use it and live like we do. But the answer is going to be nuclear. But let me show you what's going on right now, because these people are well-meaning, but they want to stop. What they're doing is they want to stop us increasing our supply of the oil it takes to run the world, of the petroleum, of the fossil fuels it takes to run the world. Now, the bottom line is we need our economy to be working well if we are going to replace fossil fuels by 2050. We're going to have all of our power in place, all of our ability to do research, all of our inventiveness. We're going to have that in place. But what they're doing is they're making it politically difficult for banks and hedge funds and insurance companies and the normal sources of capital. They're making it very difficult for them to invest in increasing our supply of fuel. And if they don't lend the money, the companies that have the ability to do it, don't find the fuel. And that's what's happening. And we had a big drop in the amount of energy that we were generating during COVID, and that has not been replaced. We have not gotten back even to where we were in the year before COVID because of political pressure stopping what we are able to do, which is produce enough energy for everybody in the world and keep working on producing more sources of energy, cleaner sources of energy, so that we can have that energy transition that they want. But they are stopping the ability to do the energy transition by making it difficult to get enough energy right now to run our government, to run our country. So the bottom line is nobody with a brain really wants to stop the development of oil and gas, but just slowing down the production is going to cause a gigantic crisis as the demand increases and the supply decreases. This is a political decision. It's not about supply. The solution would be to keep using the energy we have to produce new, clean, plentiful sources of energy. It's already getting to be too late to avoid massive shortages over the next few years. Those massive shortages are going to produce the opportunity that we're going to talk about right now, because this is what's happening with the demand for fossil fuel, as opposed to the ability to produce more fossil fuel, because that takes capital. The oil companies don't want to borrow the money at these very high interest rates to produce it. The investors don't want to invest in it because it's not politically correct. And the bottom line is our ability to continue doing what we're doing and eventually produce and replace the fossil fuels is being weakened and stopped by the fact that they're making it difficult for us to produce enough fuel for the people in the world that need it and want it. A lot of people that don't really know don't understand that in the new techniques that we have of finding oil, which involves fracking and involves very, very efficient efficient exploration and production. Bottom line is that these things use up the oil in the well very quickly. In our fracking field, 80% of the oil that we find in that field is used in the first year. The rest of the 20 years that it goes on, they're using the remaining 20%. They thought that we were going to have peak oil in the 70s and 80s, but as we invented fracking here in Houston, it supplied the world. But actually, our new administration came in and made the exploration difficult and expensive. The interest rates are making the exploration difficult and expensive. And everybody thinks that they're going to get all the extra supplies from the Middle East. And the Middle East also is having their oil peak out. And so they don't really have the supplies to replace our supplies when we don't have them. Now, that leads me to the opportunity of our generation, because I'm talking today about Schlumberger. Much of what I'm going to tell you is true of Halliburton as well. But the bottom line is that here is Schlumberger, and you can see their revenues. Schlumberger does artificial intelligence, and they're partners with great artificial intelligence companies, and they're using the artificial intelligence to be better at reading the geology reports, knowing exactly where to drill and to do fracking, knowing exactly which tools are going to be best for those conditions, being able to anticipate when the tools might wear out so that they can replace them with no downtime, and all of the things that make exploration and production efficient. Schlumberger is one of the great sources of that. And here is what's happening. This is their increases in revenues that are going on. This is their increases in earnings. This is their increases in cash flow. You're reading all of that. This is a highly profitable company. And I showed you before that when you look at a 600-day moving average, and I'm not going to show you that this time. When you look at a 600-day moving average, you will see that the stock price correlates with how much money the company makes. And so this is the revenues of Schlumberger. Now you're looking at the earnings per share of Schlumberger as we go on in time. And you'll see that they're accelerating, and that's because the world needs more of what they've got. So these are the contractors, the companies that have, this is who has contracted recently with Schlumberger. Total Energies, the French oil and gas company, Saudi Aramco, the world's largest oil producer, Equinor, the Norwegian state-owned oil and gas company, has awarded SLB a gigantic contract to provide the digital solutions and teach their companies how to optimize their exploration and production. Occidental Petroleum, the U.S. oil and gas company, has awarded SLB a contract to provide these digital solutions. And Petrobras, the Brazilian state-owned oil and gas company, has awarded Schlumberger SLB a contract to provide these digital solutions and teach its people how to be more efficient. These are the earnings per share as they're going to increase over the future years. Now, the company, I want to tell you what these guys are doing. They've launched a part of their company called Innovation Factory, and that's a global network that enables energy companies to accelerate AI solutions. Now, this is created by SLB, driving innovation and sustainable performance improvement, capturing and extracting insight from the large volumes of data that they're using artificial intelligence to work their way through. They've also partnered with a company called Dateku. This is a world leader in everyday AI. It's a French company. They're using the technology and the artificial intelligence developed by Dataiku to empower their customers to leverage a single centralized platform, Dataiku, to design, deploy, govern, and manage artificial intelligence. Now, with this company and its tools, team can go beyond the lab and build real, safe, generative AI applications. And Schlumberger and Halliburton are both doing that. This is the opportunity of a lifetime. And I want to tell you that what's happening is that Dateco is not in the race to go public. What they're doing is working and making themselves more and more efficient and building a company that started out, they raised $500 million years ago. And as they built the company, it's becoming more and more valuable. And they're thinking, the world is thinking that this company may go public at for somewhere between $4 and $10 billion. They thought it was worth $4 billion a couple of years ago. They think the company's worth $10 billion now, but this company does not want to waste its time going public and doing an IPO. They're too busy making themselves worth more money. But remember that they produced all of this value, starting with raising $500 million. Now, another opportunity, another way of looking at the opportunity is Vistra, another way that we're going to replace the energy in the world and do the energy transition. Vistra is a Texas-based retail electricity and power generation company. It's the fourth largest owner of nuclear generating power in the United States. Last year, they announced that they were buying, with a little bit under $4 billion, Energy Harbor. This is an Ohio nuclear power and retail energy business. The deal was completed last month, and now they own and operate 3 nuclear plants in Ohio and Pennsylvania. And they are producing over 4,000 megawatts of electricity with nuclear. Now, their exposure to nuclear generating is significant. And nuclear power accounts for about half of their total generating capacity right now. And they're working on committing billions of dollars to building new nuclear plants, which they see as critical and important, critical and valuable, and cannot be avoided. They're also important to the reliability of the electric grid in our interconnection. There's a regional transmission organization that serves 65 million people in 13 states. And they have said, that name is PJM, and they have said that nuclear power is essential to maintaining the electric grid and keeping the electricity where we need it. So their exposure to nuclear is going to grow over the coming years. And they're buying back $1 billion worth of shares every year. Now, this is their financials. And one of the things you can see is that their common shares outstanding are going down, not up. You see that over the years. They're buying back, they're retiring shares, making their stock worth more money. This is their revenues as they're going to be increasing per share. Now, you see what happened was that, remember that we had that frost in Texas a couple of years ago, and Vistra had to return. They own Texas Utilities. Texas Utilities had to return a lot of money to the people of Texas, and the stock went down, and it has not really recovered. But you can see that their cash flow is growing very rapidly, and it's way beyond anything that they ever had before. Their earnings per share are growing, And their capital spending is about double what it was in 2022. Bottom line is they're investing in creating more infrastructure to generate more nuclear powered electricity. And by the way, they're taking advantage. Our government was encouraging people to retire nuclear plants a couple of years ago. Now what they're doing is subsidizing nuclear generating, and Vistra is taking advantage of those guaranteed loans by the government, investing the money and also retiring the stock. And so what you're looking at is the likely price when Vistra averages 5 times its cash flow over the years. That's the stock price, averages 5 times its cash flow. Now you see the cash flow is running up, but Vistra's stock price is not, because people are still living in the past and thinking about the issue that they had before, which was when that frost and they had to return money. Bottom line is Vistra is increasing its cash flow, retiring its stock, and at 5 times cash flow, it looks like a couple of years from now that stock is going to be somewhere in the 80s and 90s. And in an ebullient stock market, it could even be higher. If you look at what's happening with their options right now, this is a tremendous opportunity for us to take a long-term position in Vistra using very, very little capital so that we can own a lot of it. And this is the picture I wanted to show you. Here's Vistra stock, and here it is right now at about 34. And the stock went down a couple of percent. It went down a couple of percent because of the current earnings report. Because what's happening is Vistra made sure that they will never have that kind of a situation where they lose a lot of money again, like they did a couple of years ago. So what they do is they hedge their business. And so when the business, we had tremendous amount of 105, 110, 115 degree temperatures in Texas. And because they were hedged, they didn't really get to take advantage of that, but they are making sure that they can keep everything stable. So they keep themselves hedged so that the business is stable. The stock went down about 3% this week because of the fact that the earnings were not as high as some of the analysts were predicting based on the amount of electricity everybody had to use because of the high temperatures. But the bottom line is that with the stock right now at 34, a 40 option that we can buy at about $2.50, when the stock price is at 80 a couple of years from now, as the world goes nuclear, we're talking about turning $2.50 for this multi-year option into about $40. If we required an additional couple of years, and you see that the stock, if you want to see what's happening to the stock, everybody that is paying attention knows that this is happening right now. So this is what's happening to the stock. And remember, this is what's happening in a bear market. But even if it required another couple of years and I had to put in another $2.50 or another $3 to get myself a couple of more years of time to allow this to happen, the chances are that I will already have made a bunch of money on my first set of options at 40, and I will be able to be in perfect position to renew this and extend it so that I can give it a few more years. And I expect that I will not only make a bunch of money on these, but I will also extend it for a couple more years, and that I will be taking advantage of any sell-off in the stock market in 2025 or 2026 to renew my position. This is one of the opportunities of our generation, and it is available to us right now. The smartest funds in the world are stocking up on Vistra options right now. And this is what's happening with those options right now. 40 call starting in August was at about 75 cents, and it is now roughly 3.5 times. It has gone up by 350% just in the last few months. And remember, this is a bear market that we're in. This is an inevitable development that's going on in the world because of the energy transition that will lead to replacing fossil fuels with nuclear. So that's it for today. I thank you all very much, and we'll see you next time.